This is part 3 of our Chapter 4 video lecture. In this video, we're going to be recording transactions dealing with the selling of merchandise to our customers. Now, before we take a look at the specific transactions, let's review the calculation of this important number called gross profit. So we're looking at the sales we made for this period of time, be it a month or a year, as adjusted for any discounts we give our customers or items that are returned by our customers or allowances we give our customers, which we'll talk about in this video. Then we're going to subtract out the cost of those same sales. Remember, this first figure is the revenue we're going to be collecting from our customers. And then for that same merchandise we sold, here is our cost of that merchandise. Now, if we purchase merchandise but didn't sell it, it's not going to be included in this figure yet. We only deduct the cost, our costs, when we sell the merchandise to our customers. And then the profit we made, the difference here, is called gross profit. And from this gross profit, now we have profit to pay off other expenses of our business, like our rent, like the utilities, like the wages and salaries of our employees, eventually going down to the bottom of the income statement to get that net earnings or net profit, or what we learn in our chapters, the company's net income. So whenever we have one sales transaction, let me just call this one. Yeah. Every time we have just one single sales transaction, there's going to be two different journal entries we're going to record. Here, this first one, I'll label it B, is to record the company's revenue from that sale. And here in chapter 4, when we sell merchandise, the name of that revenue account was called sales. Let me write that out. The name of the revenue account is called sales. And at the same time the revenue is credited, another account, an asset account, has to be debited. Typically, it's going to be either cash if we collect the money right away, just like selling at a store over-the-counter cashier, or if we bill the customer, we're going to wait and collect the money, but first set up an account called accounts receivable. And then later on, maybe next month, hopefully we'll collect the cash on that accounts receivable. And then the second transaction we record at the same time for a sale is to record that expense called cost of goods sold, okay, increasing expenses with debits. And at the same time, we have to credit something else, here decreasing the asset. And that asset is the one we've been learning in this chapter called merchandise inventory. You got to reduce the merchandise inventory asset because that inventory is gone. It left for the customer. So let's take a look at a sale here. Our company Zmart sold $1,000 of merchandise on credit. Okay, so this is the amount the customer is eventually going to pay us. Now, the same merchandise cost us, Zmart, $300. In other words, we bought it for $300 and then later on sold it for $1,000. But we don't deduct the cost of this $300 as a cost of goods sold until you sell it to your customer. So here on November 12th, remember two different entries. The first one is to record the revenue. Sales is our revenue count. Sales are increased with credits. At the same time, we're debiting another account. Not cash. We didn't get it yet. Hopefully, next month in December, we'll collect on this receivable asset that we're setting up now. Okay, so that's transaction A for this first sale, yeah? And then transaction B is to record the cost of the sale. We got to take out that inventory of $300. This is our cost. Again, this is the cost to our customer up here. So we're taking it out of inventory and we're debiting that expense called cost of goods sold. Again, these are the two new accounts we're learning here in chapter 4. So this is a pretty good deal, yeah? We bought merchandise at $300 and we marked it up more than 3 times and sold it to our customer for $1,000. So the profit we made just on this one sale, remember profit, gross profit, is the sales price minus the cost of goods sold for that same merchandise. Sales price 1,000, cost of goods sold 300. The difference on this one sale is a gross profit of $700. Now, with that $700, it's going to help your company to pay off other bills, other costs of running a business. So when we sell, we can give terms to our customer to pay off the bill. So let's say we sell it over here and then we wait maybe a whole month, 30 days, and collect it down the line. But if we want to motivate our customers to pay off their bill early so we can get some cash to pay off our bills, maybe we'll have them pay off early here and give them a sales discount. Okay, from the viewpoint of the seller, a discount is a sales discount. From the viewpoint of the buyer, that same discount we learned in the previous video was called a purchase discount. Okay, so we make the sale here, be it collected at the regular due date or collected earlier at the end of the discount period. So let's say again we make the sale here on November 12th and we have those two entries again to record the revenue, to record the costs. But now within 10 days, November 22nd, our customer pays off early. So they're no longer going to owe us this $1,000 receivable. So we zero it out with a credit. But you're not going to get $1,000 cash. Remember now you got to give your customer a 2% discount. So that comes out to $980. And again, way back in chapter 2, seems like months, years ago, total debits have to equal total credits. So we need another debit of $20. Not going to the sales account, but this is a new account just to keep track of the sales discounts we give our customers during the period of time, a month or a year. So this sales discount account is almost like an expense. In fact, it's the opposite of a revenue account called a contra revenue, here being increased with a debit. So eventually now when we look at the sales discount account, we can see how much discounts we've been giving our customers throughout the month or year. We want to be able to track that. So we set up a separate account for that versus having it reduced straight into the sales revenue account itself. Okay, so total debits equal total credits. But if the customer never paid us off early, then we still have to wait and collect the $1,000, this receivable, when it is due on December 22nd. So we zero out the receivable with a credit, offsetting this debit. And then here's all the money hopefully coming in, all $1,000. No discount given to the customer because they missed paying off within that 10-day discount period. So in addition to giving discounts to customers, there may be other reductions to the amount we're going to collect from them. So this is the mirror image of what we saw in the previous video. In that previous video, you was taking the viewpoint of the purchaser buying merchandise. Now here we're taking the viewpoint in this part 3 video, the viewpoint of the seller. Here we have taking back returned items from the customer. Okay? They don't like it or something's wrong with it, so we take it back. Or here, we tell them to keep that item, but we're going to reduce the price, or that's called an allowance. Now, in both cases, we're reducing the amount we're going to collect from the customer. But in the case of the item being returned, not only you have to reduce the amount you are going to collect receivable, but you also now have to increase the merchandise inventory account for the merchandise the customer returned. But in this case here for the allowance, remember now the merchandise was never returned. You're just reducing the amount that you're going to collect from that customer. So let's take a look at some examples. So here we have a customer that's going to return $15 of merchandise we sold to them, it cost them, we charged them $15, but it cost us, that merchandise, only $9. So just like when we had sold to them previously, there were two journal entries. Now we're going to have two journal entries here for the returned merchandise. In this case, setting up a new contra revenue account called sales, not discounts, but sales returns, which is our case here, and allowances for the amount we're not going to be collecting or going to be refunding in this case. And the offsetting credit, we're assuming that we already got the money from the customer. Here's a refund, cash credit going to the customer. Now, if you didn't yet collect the money from the customer, possibly what you're going to be crediting here is the amount they owe you, accounts receivable being reduced with a credit. But in this case, we're giving them a cash refund. Or, and now, in addition to this refund, we have to put back the inventory we received back from the customer, increasing the merchandise inventory asset with a debit, not for $15. Remember now, we're told it cost us only $9. So we took it out before when we sold it at $9. Now we're putting it back in at its cost of $9. Notice we're reducing the cost of goods sold expense here with a credit here. So again, whenever you have a customer returning merchandise back, there are probably going to be two journal entries. One for the refund or the credit, reducing the amount collectible. Again, notice using this new account called sales returns and allowances. And the other to put back the inventory itself into the merchandise inventory asset and reducing the cost of goods sold expense. So let's say we tell the customer that's dissatisfied, keep the merchandise, don't send it back. What we're going to do is reduce your price. Here, give you an allowance. In this case, we had initially sold $40 worth of merchandise. And instead of taking back that merchandise or part of it, we tell the customer, keep it. But now we're going to reduce your bill by $10. So again, we use that same account, sales, returns, allowances, a contra revenue, opposite of a revenue. Here, increase with a debit. And the offsetting credit is a refund, cash credit. Or again, if the customer still owes you the money, accounts receivable, we would reduce the accounts receivable with a credit. Again, in this case, we're paying them a refund. Let's stop here, and in the next video, I'm not sure if that's going to be the last one, we'll talk about adjusting journal entries for a merchandising company and closing entries for a merchandising company and preparing the financial statements for a merchandising company. Again, that's in the next video.